talk about one of the most basic, yet most misunderstood tools in trading. The trend line. We've all been there, right? You see a trend line break. You jump into a trade and bam, you're stopped out almost immediately. It's incredibly frustrating. Well, in this explainer, we're going to show you exactly why that happens. And more importantly, how to stop it from happening ever again. So here's what we've got lined up. First, we'll dive into the common trap that catches so many traders. Then, we're going to build a rock solid foundation for drawing these lines the right way. After that, we'll get into the fun stuff, telling the difference between a real breakout and a fake out. We'll even walk through a trading strategy, and finally, we'll uncover the secret that really separates the pros from everyone else. All right, first things first, let's talk about the trap. You know, the biggest danger with trend lines is that they look so simple. Anyone can connect a few dots on a chart. But drawing a line that the market actually cares about, that's a whole different ball game. And getting it wrong is a fast track to losing money. So let me ask you this, and be honest. Have you ever drawn what you thought was the perfect trend line? You get into the trade when it breaks, and then you just watch in horror as the price immediately reverses and hits your stop. If you're nodding your head right now, you are definitely not alone. And the problem isn't the market. It's probably the line you drew. And this right here, this says it all. The core mistake is treating these lines like they're impenetrable walls. We see a line, we trade the break. No questions asked, but it's not a wall. It's often a trap. If we don't understand the why behind the line, we're just guessing. Okay, so let's get our definition straight, just to make sure we're on the same page. A trend line is just a diagonal support or resistance level. Simple, right? In an uptrend, you connect the bottoms, the swing lows, to see where buyers might step in. In a downtrend, you connect the tops, the swing highs, to see where sellers are. It's just a visual guide to the market's flow. So how do we avoid falling into that trap? Well, we need a system, a clear, repeatable process. So let's walk through the exact 4 steps to drawing trend lines that aren't just pretty but are actually useful. Okay, it all starts with step 1, finding your anchor points. And this is so important. Don't just connect random little bumps. You're looking for the obvious turning points, the significant swing highs or lows that lead to a sharp, powerful move in the other direction. That clean move away tells you the market respects that point. Once you have at least 2 of those, you connect them. Step 3 is all about consistency, which we'll get to in a sec. And finally, step 4. This is the real secret sauce. Always look for confluence. Your line is 100 times stronger if other signals agree with it. Now, let's talk about consistency, because this is where a lot of people mess up. The big rule is this: pick a method, either the wicks or the bodies of the candles, and stick with it for that specific line. Don't start switching back and forth just to make the line fit the trade you want to take. As soon as you do that, you're not analyzing the market anymore. You're just confirming your own bias. And that's a dangerous game to play. So what is this confluence thing I mentioned? It's when multiple technical factors all point to the same area. Think of it like this. Your trend line is one witness in a court case. It's good, but you want more proof. Does your trend line also line up with a major horizontal support level or a key fib level? When you have multiple signals all converging in one spot, the odds of that level holding go way up. Okay? So you've done everything right. You've drawn a beautiful confirmed trend line, and now price is breaking through it. This is the moment of truth. Is this a real breakout, telling you the trend is changing? Or is it a nasty fake out, designed to trap you and take your money? Well, the candles will often tell you the whole story. A fake out, it usually looks kind of weak. You'll see small, hesitant candles with no real power behind them. But a true breakout, oh, that's different. You're gonna see big, powerful, energetic candles blasting through the level. There's clear momentum and follow-through. It's like the market is shouting its new direction. At you, Siri is one thing. But let's actually put this into practice. We're gonna build on all these ideas to create a smarter trading strategy, one that's less about being first and more about being right. So how do you stay safe and avoid those fake outs? The answer is patience. It's really that simple. Instead of trying to nail the exact moment of the break, pros wait. They let the market prove itself. They wait for it to not only break the old trend, but to clearly start a new one. So here's a much safer game plan. First, you wait for that powerful, energetic break we just talked about. Then you wait for the market to create a new high. A break of structure, but here's the real pro tip. You wait for it to do it again. That second break of a high confirms the new uptrend is for real. Only then do you start looking for a safe entry on a pullback. All right, it's time for the final piece of the puzzle. This is the concept that will completely change how you see trend lines. We're moving beyond just drawing lines on a chart and into understanding real market behavior. I want you to just think about this for a second. Everyone who's buying off that nice clean trend line, where are they putting their stop losses? Right, just below it. So what you have is a huge cluster of sell orders, all sitting in the same spot. To a market maker, that's a giant pool of liquidity. It's like a magnet, and this is the professional's edge. They don't just see a line of support. They see a target. They know that big money players have an incentive to push price just a little bit further, to trigger all those stop losses. That quick dip down to grab the stops. Well, that's the fake out that traps everyone else. So what's the big takeaway here? Drawing a trend line the right way isn't about predicting the future with 100% accuracy. It's about mapping out the market psychology. It shows you where the obvious trades are being placed, which means you also know where the liquidity is building up. This lets you anticipate not just a trend continuing, but also when it's most likely to get attacked. At the end of the day, a trend line is more than just a line. It's a map of other people's decisions, their hopes and their fears. And once you start to see it that way, you can finally start thinking one step ahead of the crowd. So the question is, the next time you open your charts, are you just going to connect the dots? Or are you going to start mapping the liquidity?